Hello, YouTube. Welcome to the 26th episode of the Jack of All Trades podcast. My name is Brandon. I'm the Bull of Bay Street, and I'm here with your favorite traders and investors, David and Kalen. Gentlemen, how you doing today?
Not too bad. Right. How about yourself?
I'm doing great, guys. Just so excited to be back on the show without all of the technical difficulties, and I was off last week, of course.
You know, we found out that's probably not even our fault. It was Discord.
Yeah, interesting.
It was like a setting that turned itself on.
Yeah, and to prove it, Kalen, last week when we did the show, you came on, didn't change your settings, it still worked, even though me and Sam adjusted mine. So it's like.
But then I had to change it when I came on this time, because I came on this time, my video wasn't working, so I had to adjust it.
Yeah, see, it's done. So
we're good now.
Regardless, we're good. We're back on. So we just closed out the second quarter of 2021. We're now at the halfway point of the year. Given that, I just wanted to focus our discussions on the key events of Q2 and look forward and talk about some of the very important themes pertaining to the second half of 2021. Before that, however, I just want to go through a very quick recap of what happened last week. So equity prices did rise last week, and major averages continued their ascent to new all-time price highs. The most significant thing, however, that hasn't been getting a lot of attention is that the S&P 500 is now on a 7-day streak of records, which is nothing short of incredible. Something that hasn't been accomplished since the year 1997 when we were in the midst of the dot-com boom. What do you guys think about that? 7 days of all-time highs. Straight.
Yeah, I saw that at the end of last week and I couldn't believe it. So I went back and looked at it and was like, yeah, that's pretty impressive.
My Twitter's going off the handle with economists and research analysts saying like this is going to be just like the dot-com bubble. They're all warning about crashes and whatnot.
Well, the great thing is, if you would have looked at 1997 and you would have said that, you would have missed out on, I think, over a double on the S&P.
Yeah.
I can see that.
It's different now too, right? Like, I mean, we got all these tech stocks booming and stuff, but it's not like we're growing the internet. Like, these are all new companies that are advancing and everything like that, right? Like, it's like David, that thing that you sent me before, the guy that was talking about the dot-com bubble, he said it was basically just like a race to get into the internet, and then, you know, like, so these companies grow and grow and grow, and then all of a sudden they're just here and they stop. So that's when everything crashed, right? Whereas now we're in a stage where all these companies, they're growing really rapidly, but there's still, like, from what I'm seeing, a lot of room for upside. So I don't really see that ceiling or that big bubble that everybody's talking about personally. I don't know what you guys think.
Yeah, Stan was right about that. Like the dot-com bubble, the major difference is people were investing a ton of money into thin air. Like, those companies didn't even know how to make money on the internet. Today, a lot of companies are getting investments, but a lot of them are generating crazy revenue too. So.
Right.
And it isn't even like we've been having these crazy up days. Like, if you look year to date, I think Apple and Amazon are like relatively flat. And these are two of the three biggest companies on the S&P. So I think that says something. The market just keeps on marching higher day after day with these small little upticks. And we haven't really had a correction. We've had these sort of little setbacks on like the hourly chart, like we'll gap up, we'll fill the gap, have like a low wick, and then sort of march our way back up. So it's like you can't really hold it down. And I think a lot of that has to do with yields. And that's the second thing that I want to get into that happened this week is that the US 10-year yield, it just continues to drift lower. The US 10-year yield closed the week at 1.42%. I think we can contribute that to a number of things, such as waning inflation fears, and people are realizing that economic growth is going to be more muted as we recover out of COVID and things begin to moderate. We may not have that 6% growth next year, or maybe something more like 3%. So people are sort of tempering their expectations. What's really incredible before we get to the chart is that we called that on this show. We called it in late March. We also called for a rotation out of value and into growth, which is exactly what played out. So if you were listening, you were rewarded with some great knowledge.
What do you think, Kalen? The chart.
Yeah, I mean, I've been watching it the past few weeks, and it looks like it's just kind of tapering off, and all the stocks are just getting stronger and stronger. Like, you know, I'm in a lot of tech stocks myself, and they're all setting up. I love all the patterns I'm seeing, all the technicals, like Amazon, Apple, you know, like Nvidia, all these big charts, all these strong companies are just like, they just look incredibly bullish. Like, they're in massive uptrends. there's no signs of slowing down, and like overall, I love all the charts I'm seeing myself.
You see
What do
on
you
your
think,
end
David?
like the tradings. Uh I don't have too many thoughts on on the bonds, except that I find it's interesting that between the 5 year and the 30 year, their charts look like almost identical, which is curious to me because I'm wondering why the time frame. When they say bonds duration is what's important, right? So like, how come they're not kind of differentiating in terms of duration? Like 5 years and 30 years, interest rates and inflation could have many, a huge effect or difference.
So
I
I
just thought
think
that was curious.
that's completely structural, and we went through all of the structural factors on the last video when we were talking about the inflation illusion. But the interesting thing is, moreover to that, is that I'm noticing, like, obviously it's great when you have a steepening yield curve, but I'm noticing that the yield curve is starting to flatten a little bit, which from face value may not seem like a great thing, but if you're investing in growth companies like the companies that Caitlin just listed, that's great, because if you're not going to have the really strong GDP, you're going to want to be investing in companies that are going to grow, even if the economy is not growing like 6%. So you want to be with the Facebooks, the Nvidias, the Amazons, the Apples, the companies that are going to provide like 20% year over year revenue growth, despite what the economic climate is. And I think, again, what we were talking about the other day is the TINA trade. Bond yields are so low. Where else are you going to get a return if the 5 years, 1%, the 10 years, 1.4%, you're not going to get a return anywhere. So I think the two are inversely correlated. So when I see everything starting to flatten, it's just another call to buy stocks, and we're just being validated by the bond market.
Mm-hmm. Yeah.
Did we actually say on the show those months ago that, because I know we talk in private, we're like
We
we're
talked
like
in
inflation.
private several
Yeah,
times. Yeah.
like, the inflation was kind of fugazi a little bit, like what the media was talking about it, and then we were saying like this whole energy thing, this rotation to the value might be a really bad move, and then we all took positions in growth, so
Yeah.
it's kind of working out now.
Yeah, I mean, it's literally exploded. Nvidia, since we made that call, is almost up 100%. What's it up, like 80%?
Yeah.
And I know, you guys are all in with me on that. But if you can pop up the 10-year again and just put it on like a monthly and really just zoom out, because in private, me and you were talking about this even before I joined the show, and it's just a series of lower highs and lower lows, and it's just a channel going lower. Like, even if you can go like multiple months, can you like a 2 month time frame or something
I
else?
can give you a year, 1 year bars.
Yeah. So this is just not a chart that I want to buy. Like, we're just in a secular, like, this is the new normal. Rates going lower. I'm not going to say rates are going to go negative. I'm not sure if I'm that crazy yet. Maybe one day I'll be saying that. But right now, I just think low rates this is the new normal. This is what life is now. And
I
it's not
suppose.
even the 10-year. Look at the 30-year too, man. 30-year gives you even more insight.
Yeah, they're looking the same.
Mm-hmm.
It's COVID right there.
Is that the
What's
30-year yield?
This is the 30 year, yeah.
Yeah. So that just tells a story there. I always say charts tell stories. And this is all because of technology.
Especially zoomed
Technology.
out this far. But what concerns me is like it looks like it's not just like a channel going down, but it's also like, have you noticed it's like a widening channel?
That's
So
in
it's
log?
like this is a log, yeah.
Okay, pop it
Yeah,
out of log. I'm just curious to see what that looks like.
oh, yeah,
That's probably real bad.
yeah. There you go.
Okay.
Actually, you're right. It looks more like a channel in the thing.
Mm-hmm.
But
Well,
yeah,
it's definitely going to be interesting to watch. We rejected, what was it, the 200 on the 10-year? So I'm just curious to see what level that we're going to have to bounce off next, and to see what
200
direction
week.
it's going to take.
Yeah, last week it looks like we pierced 200 week and bounced off a bit, and we're coming back down probably.
Well,
No, sorry,
it's
that's the 200. That's the 50. My bad.
yeah. So we're just literally in no man's land right now, just kind of consolidating between both of those moving averages and just trying to find a direction.
Which makes sense because which makes sense the bond market would be kind of confused or iffy right now because you really don't know what's going on with inflation. We all thought, or they all thought they had an idea of where inflation was going, but now it's like not so clear.
Mm-hmm. Yeah, but inflation, even like compared to last year to this year, like the biggest thing that we were kind of talking about a little bit was it wasn't really a good correlation because if you're comparing, quarter two to quarter two or whatever you're going to look at those time frames, we had, like a 3 month free fall. So if you're looking at that, if you're taking a time period in the middle of that market crash and comparing it to this year, those numbers, like they're not irrelevant, but they're really, really skewed, right? Like you almost have to take that big COVID drop out of the picture to get a better idea on the longer term of what real inflation is, and it's not nearly as bad as it actually showed in the numbers, and that's kind of what we were talking about.
I absolutely agree. And if you took the inflation stance when it was like, peak inflation, when they were talking about it on CNBC and TikTok and Reddit, you were buying Bitcoin at 60,000, you were buying gold at the peak, you were buying copper at $5. Like, you've really been burnt. So it just shows you sometimes you got to zig when other people zag. And
Hmm.
sometimes you have to make your own point of view because, I always say when everyone's on one side of the ship sinks, right? So that's one thing there. Um, do you guys want to move on to
I
what
thought
do
that
we
was a
have here
good
next?
segue to go to Tom Lee's thing.
Perfect. Yeah, we can go on
Yeah.
to Tom Lee's article.
Because I think it was him that, or I know a lot of people mentioned it, but to Kalen's point, he mentioned like the comparables are great. It's great for headlines, but then now we're moving out of that phase where the year over year is like it's not as skewed anymore because of COVID. So now like you get some real data.
Well, that's the thing
Tom
we
Lee.
talk about all the time too. Is like when you're watching news articles or CNBC or anything. I don't know where you get your news. Like half people get news on Facebook nowadays, but it's like any
Talk.
news station. The only reason or Reddit or whatever, but like the only reason that they make money is if they get viewers, if they get clicks, if they get likes, all this kind of stuff, right? So like any news station has to catch your attention. So they're
I
always
don't
like,
understand, Kalen, the type of people that go on Reddit or go on Twitter or CNBC and like actually looking for ideas for stocks on those platforms.
yeah, well,
Like,
those, I
why do
mean, it's
I've
easy,
never
right? Like it's the easy way out. You just look and you see some post with 10,000 likes where everyone says, "Oh, stocks are going to crash, so you better put your money here." Like, "Oh, this stock is going through the roof, so just buy it." And somebody just you're scrolling through and you look at it and you say, "Oh, 10,000 people like this.
what
There's
does
500
somebody
comments.
else
Everybody,
what does
hey,
somebody else know that we don't? We
exactly."
all
And
have
if
access to the same amount of information, the same charts, the same data. Like, we're all, in it trying to figure it out, right?
Yeah, but that's the thing though, is that like a lot of those people don't know how to read charts, and like a lot of people are too lazy to figure out how to do that, right? Or even people that they aren't necessarily lazy, they're just they just want that quick money. So if they read some big exciting headline that says this stock's gonna go up 80% in the next 6 months because of these reasons, and inflation's through the roof and blah 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 blah, then everybody's gonna be like, oh, okay, great, I can make some quick money. Let's throw a whole bunch of cash in here, and then that's the end of it. They just put it in there and they say, "Oh, I read this headline and this is what it told me to do." Right? They don't actually look into the background like guys like us kind of do. Like some people do, but like we like all of us basically, and you guys can correct me if I'm wrong. I think we'll see a news headline and we'll go, "Okay, well there's obviously something going on here. Otherwise there wouldn't be a headline. So let's dig into the background and see where this headline's actually coming from." Like like David, that headline about Tesla where they said they sold like half as many cars in China, and then it was like 3 days later the actual results came out and they sold like twice as much. It was like
Yeah.
the complete opposite. So you saw the headline and you're like, okay, well this doesn't really make sense. So let's dig into this. You dug into it and then you bought the dip because everybody panicked and sold, and you had a nice little swing trade over a few days, right?
No, I still have it. I'm up $80 a share now.
There you go. Because you didn't listen to the headline. You saw the headline and you saw, okay, how can I actually find some real knowledge behind this to use it to my advantage, right? Instead of just following the headline.
Yeah. Yeah.
So
Yeah.
we share a lot of articles in the group between us, and I would say 90% of the time I'm just face bombing. These articles are just ridiculous.
Yeah,
And it
yeah,
and
for
it,
sure.
it's all the same recycled garbage. Like, it's an article that really was put out 6 months ago or 1 year ago, and now it's finally sort of getting a little bit of traction. Like, they're telling you all the reasons why you should buy, let's say copper because there's inflation, whatever. And I'm like, man,
Yeah,
we were talking about we were pricing in the inflation narrative last August. right? The
Mhm.
market's the best forward discounter, right? It's discounting things 8 to 12 months ahead. So that's what I always say. Do you want to actually, before we get into the Tom Lee article, pop up the sector performance for Q2 just before we get into
Yeah.
what's going to happen
Which
in the second half of the year? We could talk about what's going to happen now. It's the bar charts.
Just a quick note, I gotta tell you guys, just because I see stuff like this in small caps all the time, and it's so much worse. Like, just an example off the top of my head, there was one time I saw a company, a couple of years ago, I can't remember what it was, but basically they released a news headline that said, "We're now selling our products on Amazon." And it's like some super small company, so obviously, the thing gaps up 50%. So literally 30 seconds, looked into the filings, looked at the company. It turns out they've been selling their stuff on Amazon for, I think, a year and a half already at that point. So, they released this, but they just released the headline because you can do that because they're not lying. Like, they are selling their stuff on Amazon. They've just already been doing it for a year and a half. So stock gaps
Right.
way up. Everybody gets excited, and then, it crashes.
I never trust small caps because that's what they do. I mean, they use the term pump and dump, right? And that's exactly what they do. Their investor relations just go and they just have a approach where they just put out these staggered PR, and they just basically, give all these bogus releases of news articles. Basically, oh, this person bought stock. We have a partnership with this company. And it's all like a solid company like an Amazon. Like, they don't do that. They just put their head down. They work. And when they do have an announcement or something that's noteworthy, they'll put it in the news release for the earnings release.
Yeah,
dude, that's why Kaylin shorts the shit out of them.
Yeah. But that's almost like kind of like what news stations are, right? Like news stations are like the pump and dump guys. Like they just release these bogus headlines to get stocks moving, and then it just does the same kind of thing, and just on a bigger scale.
Dude, you're
Remember
like
I
the
posted that
anti-Robin
article?
Hood, man.
Which
Essentially, yeah.
That was great. AMC crashed a little bit last week, so I just shorted the hell out of it, and it was nice.
I was just gonna say, remember that there was an article I posted, I think a few weeks ago. It was a Canadian mining company. Their stock pumped. I forgot what name it was. I even played it last year, but I didn't know the story behind it. But basically, they paid some writer from like the FT or whatever in the UK to release an article suggesting that they were talking to Tesla to be a supplier for Tesla. And their
Yes, I
stock,
remember the company.
remember? And then their stock went Giga Metals. I can't remember.
Giga Materials or whatever.
Oh, yeah, I remember that one.
Yeah,
GIGA.
right?
Yeah, I remember that too.
So it got uncovered that either the writer was paid to write the article or he's just that stupid. Either way, he caused the stock to spike because there's literally no connection between that company and Tesla. But he wrote that there was, and then so the stock went up and then came back down.
Yeah, I think I actually played that because I remember that.
That's awesome. That's awesome.
Yeah.
All right, on to materials or the sectors. Let's see. What do you got, Brandon?
Yeah, the sectors. Yeah. So I just wanted to go through, this is a performance of Q2. And as you'll see, the S&P 500 returned 8% for the quarter, which is crazy because that's essentially what you would get in your average year. What's interesting is that the sectors that led the way, real estate up 11.4%, technology up 10.6%, communications up 10.2%, healthcare up 10.1%. So these are all non-cyclical and generally growth sectors. And when you look at the sectors that underperformed, financials, industrials, materials, and with the exception of consumer staples and utilities, because those trade like bonds, these are all cyclical sectors, one that you would expect to do poorly when there are declining bond yields and there's a shift from value to growth. So I think this really plays to the narrative, which we were talking about on the show, and just to say that we were really on top of this. And I think this continues going into the latter half of the year.
Wait, so just so I'm clear, like this was the previous 3 months, right?
Yeah. So this was the 3 months, June, May, April.
Wait, so that means during the previous 3 months, when everybody was pounding the media saying go into value, go into whatever, that those are the exact same sectors that are underperforming.
Yeah, exactly.
That's awesome. CNBC people, that's where you get your news.
That's awesome.
Oh man.
Yeah, it's interesting because the cyclicals, I will say, they were market darlings in the first few quarters of 2021, the best performing sectors I want to say were like energy, financials. Energy still had a good quarter. It was like what does that say? 8%.
Yeah.
But you have to keep in mind, like energy is very seasonal. Like it's the summer driving season, and like this is the time where you would expect energy to have a little bit of an uptick. I'm not particularly excited about energy, but if you look at the industrials, the materials, those are spaces I think I want to stay away from. I still have like some great companies in those spaces that I like, but would I necessarily want to be like overweight in materials or industrials or financials? Like, is Caterpillar a name that's really exciting me right now? Absolutely not.
You could see some major drags still from COVID, like industrials, like airlines, -10%, almost -11%.
I think because they did so well in the first quarter.
That makes sense. Air freight, logistics, look at that. Home shopping, that's up.
Yeah, it's always interesting to look at the individual subsectors.
Yeah.
And I do really like this site, barchart.com. It's a really great resource.
I'm
Yeah,
gonna
I've
save
never
it. I
seen
didn't
this
know about it.
before.
Yeah.
Have you seen this before, David, or no?
No.
The other thing
Like
that you can also do is you can find heat maps also. I'm not sure if you can go to the left panel, just where we can scroll
Yep.
besides S&P 500 index. Yeah, you could probably find like a heat map. And it's really cool because you can see all stocks in the S&P 500, just little boxes, either red or green. And if it's like dark green, it means it had like a really good day or yeah, so that's not the one I was looking for, but there's one that just has like in one square, just every single stock. It's just it's really, really cool. Maybe I can show you guys after and we can pop it up on another episode, but heat maps are great and you can customize like the time frame. Like if you want to look at like the 1 year, the 5 year, the weekly, like it's great.
Ooh, alcohol down. What's the world gone to when alcohol's down?
Oh man, probably because weed's up.
Weed is not up. Weed has taken such a big hit this year. It is
Is
crazy.
it?
Yeah, it has. It's weird. You think it would have gone up with everybody sitting at home, but I guess not.
You know what? 2017, when all of those stocks went up, that basically like gave you all the gains for like the next like 5 or 10 years or however many years. Like they
Yeah.
were just amortizing the gains. Like it's I'm not sure if you guys were a part of that. I was, and it was just crazy. Like Canopy was like beginning of 2016, it was like less than $1. And by the end of 2016, it was like a $17 stock. Went back down to like $5 or $6 the next summer. And then 1 year later was like a $70 stock. Now it's back at like 25. Like just
Yeah.
crazy.
Yeah, it just makes it hard for it to climb up though, because then you got so many bag holders sitting way up there. They're just gonna be selling at every pop, right?
That is exactly it. And while we're at it, I'd love you to analyze the chart on weed because you are like describing exactly what happened in the chart.
Yeah,
So the ticker's weed.
I definitely traded every single weed stock that's out there. So
Oh, Canopy.
Yeah. Canopy.
Yeah, I
Yeah.
lost. This was my biggest loss for years. It was
Really?
like $1,000 or 12. I lost like $200, I think, in 2017, and I took $1,000 loss in 2018. And this was one of the biggest lessons I learned. This was the only time I got into a stock, not because I knew anything at all about it. It was because my best friend was in it. And he was making a ton of money.
so you just bought it.
So I hate to say it, but weed was my second best gainer of all time, besides Neo. Neo's number one. Nvidia may overtake that, but yeah, pop it up. Take it off log. I think that would just give us some real context.
Oops. All right, here we go. The monthly.
Gotta drag that guy, make it super small. Maybe you can.
That's the monthly?
This is the monthly. Yeah.
Oh yeah.
Super ugly, man.
Yeah, it's an ugly chart. Real ugly. I don't even know if it's gonna bounce there off. What is that? What's that line? That blue line? Is that the 50?
50.
mark?
Yeah.
Yeah. Yeah.
Look
That's
at this declining volume too.
I mean, there's not like if you look at the volume profile, there's not like a ton of weight above it, but like most of your weight's like kind of around where the price is now, which is good. But I mean, that's still like, there's still a lot of people that would have bought into those highs that are just waiting for any opportunity to get out, especially something like this. Like the more volatile these things get too, like you know, when you have those really sharp drops, it doesn't give people a chance to get out. So then you get panicked, and then that's when you get people selling even more aggressively into all the spikes.
So guys, how would you feel if you were a holder of Canopy, like you're a big holder, and day after day, this thing is making new lows, and you just see the market just edging higher day after day, making new highs, all-time highs? Wouldn't you just feel impatient to just want to sell your stock and just jump into something going up?
100%. Yeah, that's the thing though, right? Is like that's why when you get a chart like this, it's so hard for it to go up because, you know, like I can't see the dollar values on this thing, but like, you know, if it pops up, like you have one big green day where maybe it goes up like, you know, 20% or 30%. I mean, you might have just been sitting there doing exactly what you're saying, Brandon, just like, you know, waiting and waiting, going like, Jesus, this thing is still down. And then all of a sudden you're just so frustrated with it. You get one day where it pops up, so you're taking a little bit of your loss off the table and you just say, screw it, I'm out of here, and you sell everything, right? That's why these things are so hard to climb back up.
Down 60% since February.
Yeah. And like look at that big wick. Like I mean, you know, there's people that 100% bought right at the very top because they thought it was going to break those old highs, right?
And there's all these people selling them their bags.
Yeah, that's why you have that huge top wick, right? Is because everybody they let it go as high as it could right to those previous highs, and then as soon as you saw some weakness, everybody sold. That's why you get that massive top wick because everybody's just bailing.
So the interesting thing is that institutions were burnt in this pretty severely. Now, I don't want to say necessarily Canopy, but a lot of the other smaller ones, in the same way that a lot of institutions were burnt with crypto in the last couple months, because there becomes this notion that a sector is too big not to own. So when you're a portfolio manager or you're, you know, an institutional manager, you have to really stay disciplined. And that's one of the great things about like when you want to pick a portfolio manager, to make sure you have someone that, you know, is just super strong, someone that's not gonna, you know, fall for something like this.
Yeah.
Because the media just pumps it, being like, if you don't get into crypto, you are not going to be a part of the new financial revolution. And the
Yeah.
same thing with weed, right? At the end of the day, the way that I look at it is there's some great opportunities. Like you could probably show me some really cool graphs on like THC use and all the ailments that it helps and everything else. But at the end of the day, it's still a commodity. Like you're still growing a crop. And like, you know, the production of that goes higher, and you've seen it in Colorado, like the value that you can sell a gram of weed for goes a lot less, right? The more you produce.
Yeah, I know. Like, I remember, like, because I never bought any of the weed stores for like a long term thing, but I traded all of them like as they were going up and down. And I remember like one of the biggest reasons I didn't want to buy it, like leading into when it was actually legalized, like here in Canada and everything, was because from everything I was reading, I don't remember the exact numbers, but basically, like the amount of weed that they were going to be able to produce was significantly more than what they expected the usage was going to be. So like in my head, I was thinking we're going to have this massive oversupply and surplus of weed that nobody's going to be able to use. So like my theory was as soon as it basically got legalized, like very quickly after, it's just going to tank because everybody's going to realize that once they see those revenue numbers starting to come out versus production, and that's like pretty much what happened. So
Like,
Yeah.
sorry, go ahead, Ben.
No,
Oh,
you go.
I just want to add, I don't think, and even I didn't see this coming, but like the home growing thing, I didn't see that becoming a thing, but apparently that's like
I
really
didn't
popular
see that
now.
coming either, man.
yeah, yeah, I know like a lot of people that do that now because you know you grow. I think every like here in Canada, like one person can have like two or three plants, and like if
No,
you
so
isn't it?
I visited my best friend. I was shocked. So I forgot what his prescription was like, but I think he could have like 6 plants per gram. So if his doctor prescribed him 3 grams a day, he's got 18 plants at home.
That's
Yeah.
crazy.
He's got 3 tents.
And like think about how much you can get with that, right? You have a couple seeds and the things just grow, right? I mean, like
Dude, who
you
needs
don't have
three
to buy.
tenths of weed plants?
Well, he used to smoke 30,000 a year worth, and that was buying
Oh,
prescriptions. So
Oh,
yeah,
wow.
so
that's yeah. So he's saving a lot of money now, I guess.
yes, he is. So
Yeah.
yeah,
Well, I
uh,
really think the thing that these marijuana bulls were sort of banking on was federal legalization in the US. And if you would have listened to all of the news articles on CNBC and everything else, marijuana should have been federally legalized in 2018. Here we are halfway through 2021, and I'm not even sure what the prospects of that are looking like. just because so that they can get all like the banking acts and that you can like you can't even have a US company trade on a US exchange. All of the marijuana companies that are trading on the NASDAQ, like Tilray or Canopy, whatever, those are Canadian companies. So you can find US companies, but they're traded on the TSXV, I believe, the venture exchange or the CSV. And these aren't liquid. Nobody knows about them. They're good companies. And maybe there's going to be an opportunity for them to get uplisted, but that could be years away. And maybe there's an opportunity here. Maybe, you know, a couple hundred episodes from now, we'll be doing the sort of cannabis segment, but not sure if that's right now.
Yeah, it was like
about the
one of the stocks I was swinging earlier this year was it was Indus, was a company. They're in California.
Yeah.
And then they their cannabis company, they have like they're really great company. Like they're in the States and they have like beverages. Right? Yeah. So they have like beverages, food, like they do all kinds of stuff in all different areas. So it's a solid company. And it was like the time it was like $1.50 a share or something. So I bought a whole whack load of that. And no, it went up. So I bought a whole bunch of that, and then it spiked up to like $2.50 pretty quick. So I sold like 90% of my position. I was going to buy back some lower, so it dropped all the way back down to like $1.70. Then I bought a little bit more, and like basically the thesis behind it was that like I was kind of just waiting to see how it went with Biden and everything coming in, like with how he was going to like react to the federal legalization and stuff, and then it just kind of got lost in the woodwork. So then like at that point it popped back up to like $2 a share. I just took everything off, and now I think it's like it trades under LOWL as the ticker now. Like it got bought up by Lowell, I think, is another company.
Yeah, but, so Lowell Farms, right?
Yeah, it's basically just kind of like just drifting off to nothing right now, because I mean they could get a big order and it could just shoot to the moon, but like I'm not going to hold an investment hoping.
Interesting thing about Indus that you may not know. So you said you got in at like 150, right?
Yeah.
So I can't give you an exact number, but I believe the number they went IPO at was like 450 or 5. It was a lot higher. So that thing when IPO, they raised a lot of institutional money. I mean, these are the things you got to stay far away from, right? Yeah. So they had some crazy price, and I believe they did the financing like sometime in 2018, like during like the very, very, very peak. And then it took a few months for that thing to get listed. And then by the time it had its first trade, I'm not sure whatever price it was at, 250, $1.50, whatever, but it was already significantly lower than what the institutions got in at.
Yeah.
So that's all I know about Indus, because I was following it way back when. I don't follow it today, because what would the purpose of that be? But it's not even like a specific to like one company. Like if you look at all of the other big IPOs, like the big hypey cannabis IPOs, like they're significantly lower than what the institutions paid for them at.
Mm-hmm. Yeah, I think that was just kind of just across the board, right? Because like you said, I mean, until it's federally legal, like that's when the narrative might shift a little bit. But until that point, I mean, you're basically just, holding and hoping, and that's holding and hoping is never a good investment strategy.
Never. That's not even a strategy.
Why are you laughing, David?
No, I just had a funny thought. It's because you actually looked at some fundamental information to decide whether or not you were going to stay or buy more or whatever. But usually you just look at a chart, but like, yeah, fuck this thing, like, or like short it or like whatever.
I was holding it for longer than a few days. So I was like, I probably was something. I should probably at least know the name of the company,
So that's your threshold. After a few days, like, all right, fuck it, let's.
Once I know the name of the company, I feel like I know everything I need to.
That's awesome.
Brendan's over there just like these fucking guys.
Brendan's over there. Have you seen my library?
That's what I absolutely love about this show. I love how we all come to the same conclusions a lot of the time, but we got a short-term guy here. We got more of like a medium-term, like swing trader type guy, and then we have a long-term guy here. And we all follow technical analysis, which is great because it's a discipline that a lot of people don't use, or they say that they know it, but they really don't. And we incorporate fundamentals, we incorporate quantitative research and everything else. And we really agree on a lot of things. We disagree on some things, but it's great that even though we come from completely different backgrounds, that we often are able to come across the same conclusions.
Yeah. Well, the cool thing I like too is like anytime any of us are looking at a chart, we can just like send it to our group, because I know all three of us use different ways of finding our levels. Like David loves Fibonacci, like, I know that Brendan, you love, your moving averages and just your straight like horizontal levels. Like I'm a big horizontal level guy myself, and I like the line chart, which I know neither of you guys use. And we'll send something out there, won't tell each other like what we're thinking. We'll all have like a number in our head, and then we'll say, where do you think it's gonna go? And usually we're all within like a pretty small margin of each other. And if one of us is way out, then we kind of have the ability to reassess and say, okay, well, we're usually all pretty on point with our target. So what's going on here? Maybe there's something we're missing.
Yeah, it's a really good point.
Yeah, it's great. Not to toot our horns at all, but we've all been very successful this year. 2021's been an excellent year. And definitely a good segue to that is that we think that things are about to get even sweeter. And I think that's a great segment towards Tom Lee's article.
Tom Lee. Do you want to explain who Tom is to those who don't know him?
Yeah, so Tom Lee is one of our favorite market strategists from Fundstrat. So he updated his S&P 500 target to 4,600 by year end. And right now we're at 4,350. So I think that implies, what's the gain for the year on that? Like
8%. Oh, for the year? I don't know.
But if you pop that on what we already have and then compound that, I think it's like over 25% gain for stocks this year. I definitely think that it can happen. If we start to get breakouts from large cap tech, like if Amazon breaks above 3550, Apple breaks above 145, 4,600 is going to happen. It's in the cards.
I think we will, man. I have a bunch of Apple and Amazon, and I love the charts. Like they're just breaking out. They're looking super strong, and like that's the nice thing about these big caps is you get that stair stepping pattern, right? Like they go up, they consolidate for a while, and then even like a year and a half, and then as soon as they break out, you just get this big straight push way higher until you get the next consolidation level. And from looking at the charts completely alone, I mean, we're just at the top end of those consolidations now. So
Amazon is about to break out imminently.
Yeah,
like me and you have talked about this, David and I, we've all talked about it together. Amazon's going to break out imminently. I think Apple's like almost there.
Yeah.
But I think that's Apple right there. I saw on my chart. Yeah, our charts aren't the same for some reason because I got resistance at 145 and it's at 139.
Yeah, David, if you go to the 1 day chart, like Apple just broke over its previous high, like the most recent one, and it closed nice.
Big wick, right?
Yeah, there you go. So we broke out over that level, which is really nice. Now we just got to see how it reacts to the very top up there.
Like Amazon is my best idea right now, like especially for short term. Like I think that Nvidia is still the no-brainer. You just overweight that. But going back to sort of what Tom Lee said, I think that we're in a scenario where we're going to see a lot more revisions in target prices because I think it's a psychological thing. I think that as the S&P moves higher and earnings continue to beat, these analysts are going to have to raise their targets because they're not going to look smart when the S&P 500 closes at 4,500 at year end and their target price is like under 4,000. Like who's going to buy their research for the next year if they've been wrong on their calls? So I think that we're in a situation where analysts are going to have to start chasing targets, which may end up making the market go up even more. So I think we're in a really good situation if you own stocks. And I think that things are about to get even better. You haven't seen anything yet.
So I got a question for you, Brendan, just because you have a little bit more information on this than we do. So like when analysts and stuff are looking at charts, because like when I look at a chart, say like, I'm in Amazon right now, we were just talking about because it looks super bullish, like I'm expecting a big move up. Like I have an idea in my head how far it's going to go just because of the chart. But like what sort of weight do you put on that as far as like the actual like market cap of the company? Like, if you're looking at a chart, say like Amazon, let's just say you're thinking, okay, it's going to go, straight up to $4,000 because that's the way the chart looks. But are like a lot of these analysts, are they weighing in like, well, no, it's not going to go that high because then the market cap would be way too big for what it's worth. Like how much is that?
Oh, no, they're not looking at market caps. I think they're looking at like multiples, like revenue models and cash flow. And again, I'm not as much of a fundamental guy. I'm a fundamental guy from what I get from my dad and my older brothers. So right. I just sort of take from them and I learned a lot from them. I'm a technical analyst at the end of the day, but I know that these these investment firms or these investment banks, I should say, that are providing research, yeah, they'll use a lot of like fundamental metrics and multiples. And I think they're usually pretty conservative with their estimates because they want to provide an estimate that is achievable, but they don't want to make it too high because I feel like they don't want to look stupid on the high end or the low end. So I
Right.
think they like to give something conservative. In my opinion, I think they're sandbagging it. Like I don't know the exact number, but I think like the street high on Amazon's like 4,500 or like 5,000. And
Yeah.
I'll tell you, Amazon's eventually going to like $10,000 a share. It's just going to happen. You hold these things long enough, and they're innovating. They're growing their revenue 30% a year. They're extremely profitable. I think Amazon's like 40 times next year's earnings, which is like extremely reasonable considering they're growing earnings 30%. So, to answer your question, I don't think they look at market cap. They probably just look at more so fundamental metrics.
Okay. Yeah, I was just kind of curious to that because I know like when I look at stuff, like I look at the company and as a, a solid company, like when you talk about Amazon or something like that. But it's funny you say 4,500 because that's kind of that's the number that I had in my head as well. Like if we get through this breakout, I can see it making a pretty quick move to 4,500. Like that was sort of around where my target was.
But you have to
Sam, do
keep
you
in
mind pulling
mind,
this chart up?
yeah. I just want to add one thing though. Okay, you have that perfect.
So
The
I just wanted to say to your point that analysts are playing it safe. The average price target is 43, which is exactly what Amazon is right now, so they can't be wrong.
wait, is this Canadian? Because Amazon's
Yeah,
30,
it's 30 something, 35, somewhere like that.
35
This is American.
local.
So like the highest target is 5,500. The average is 43. Lowest is 37.75. This is out of 31 analysts. All
Okay,
31
Okay,
are
yeah. So
buy.
see, I don't even look at the price targets. Like I'm just going based off technicals, and I had 4,500 in my head.
Yeah, so me and you discussed this earlier, Kaylin. I think we all discussed this. That if you, I think we did it on a couple episodes ago. That like if you measure the last breakout, what we had the last breakout, and you add it on top of the consolidation that we just had, that's like I think $4,600. So it's perfect.
Yeah.
It ends up with exactly because in technical analysis we do a lot of that. You know what, David? I think I mix the two up, Amazon and Nvidia. Pop up Nvidia. I think the street high on Nvidia is $1,000, and I think it's BMO. And I still think that is crazy because this thing's going to $1 trillion market cap in my opinion.
Sorry, what was the
Exactly.
numbers? Yeah.
$1,000. There's one guy. It's BMO. They just raised it. So Nvidia is currently what 820, 840. I forget the price. It's going up too much right now.
Ready?
819.
Okay, so it's 819, and the average price is 762.
Yeah.
So this is what's going to add fuel to the fire. All these analysts, they're sweating right now because they said Nvidia was only going to go to $600, $700, and it's already higher than that. And this is the target for year end. So all of these analysts are going to be forced to raise it, and every time they raise it, it's going to cause more people to buy. So it's like they're literally just adding fuel to the fire, which is going to make this thing go even higher. And more people raise their estimates. The company continues to beat on earnings. It's just like a cycle. So it's a really good situation to be in when you have analysts raising, but they haven't done it yet.
Right.
I actually saw excuse me, I actually saw that happen with Tesla. Their Q2 deliveries, they came out at 201,000 units. And just less than 10 days ago, every analyst was like about 80, they're estimating they're going to have like 185, 190,000, the most bullish. Then like 2 days before the numbers came out, they all quickly like upgraded it to like 207, 206, whatever. So, and then the headlines, of course, the Tesla missed estimates. It's like, well, first of all, you revised those estimates two days before it came out, and before that, you were all like bears, and then now you revised it like just so you can write the headline that they missed estimates. I'm like, I think I've said this before. I'm like, estimates don't miss deliveries. Like, sorry, deliveries don't miss estimates. Estimates miss deliveries. Deliveries are going to happen. You know what I mean? Like, the performance is the performance. Your guess is what's wrong. So, like, how are you saying that? The reality didn't miss your guess? Like, it's ridiculous.
Yeah, that's a good way to look at it. I like that.
Okay, are we good with Tom Lee go to Krispy Kreme?
Yeah, so before we get into the Krispy Kreme, I just want to sort of premise it. So it was a really busy week for IPOs south of the border. They had 17 companies list on US exchanges last week. We had cybersecurity company SentinelOne, we had the Chinese ride-sharing giant Didi, but we also had one of America's favorite donut companies, Krispy Kreme. It made its return to public markets after going private back in 2016. The company raised $500 million in the offering, which gives the stock an implied market capitalization of $2.7 billion, which is just over double what the company was taken private for in 2016. The stock was priced under the expected range of 21 to 24, which is rarely a good sign, but the stock still managed to close up an astounding 24%. Interestingly, I was just looking through the offering, and the company was able to double its revenue and its EBITDA since going private 5 years ago, which they're attributing to their new omni-channel approach to leverage their donuts. And if you want to look at the stock, it's traded under the ticker DNUT on the NASDAQ.
I think it was just out for like a day or two. 'Cause I'm on the hourly, so this is what the hourly looks like.
Can we agree that there's meme stock potential with this? Not that it's anything that I'm going to touch. It's not my wheelhouse, but I could see this catching some fire.
Do they own anything else, or are they literally just donuts?
So they have donuts and coffee shops. I didn't know that they sold coffee.
$2.7 billion donut company. That's amazing. I mean, they are
Big
good.
now. Wow.
That's so funny. Yeah,
Apparently they had $1 billion in revenue last year. Sorry.
I was gonna say all the Reddit guys are gonna get all over this because like, oh, Krispy Kreme, I can see this being the next thing.
So the interesting thing is, sorry to interrupt you, David.
No.
Yeah, so the interesting thing about this is that usually when companies go IPO, they'll do a whole marketing thing, and they'll, have plenty of weeks of sort of generating hype for institutions, right? And they'll have an expected range. So their range was, we were going to go public at 21 to 24. And that's usually like a teaser price, like especially in a good market like this, they'll price it above that range. So it's like 21 to 24. And if it's a really hot IPO, as we say, they'll price it at like 26 or 27, right? This thing got priced at 17. This thing got priced like 20% below the low end of the range, which is like really not a good sign at all. But the thing still rallied to, I can't even see what price it's at, but just a word of caution. But maybe like that was a good thing. Maybe that like kind of spooked everybody out, and maybe there's not a lot of hands holding Krispy Kreme right now.
It looks like it traded up to just over $21 at the high of the day, and came back down to 18, and it's kind of settled. It closed at $19.10. So, yeah,
it's over.
I don't know.
Yeah, it was a strong intraday chart, anyways.
You guys want to see? Do you guys want to see an IPO that went IPO a few days ago that did really, really well? SentinelOne. This one got priced above the range. So again, not a lot of data over here, but I feel like we're kind of seeing the inverse here. Like this is one that's like people are really excited about it and like maybe super growth oriented and like a little bit frothy, but with really good growth. But this one got priced above the range and people were just piling into it. And I know cybersecurity
sold off on the first day, but had a nice little pop. I don't know, Kaylin, you're the expert at like pre-market pops or like whatever. Like, what does that look like to you?
What's the time frame on that?
Well, this was 9:30 in the morning, so this is on the hourly. So this was the first day of trading ended here at a low, then it gapped up the next day.
Go to like the 5 or the 10-minute chart. Information on it.
Your little
the
micro time frames.
That looks good.
It looks like a little inverse head and shoulder kind of thing.
Yeah, like I mean that's like like that, I don't know if that was the Friday or whatever, that second day there, like when you get that pop in the morning and it kind of sells off and then it just holds steady like all day long and you get that push into the close, that's a really good sign. Like those are usually the kind of things that I'll see like gap up the next day.
So is it fair to say this is probably maybe early investors, maybe some employees or anybody that was already in it for a while and just wanted to cash out?
Yeah, I mean, well, like if you think about it psychologically, like if you look at that first day there, you had that big sell off, and then the second day you had this big strong open and it popped right up, but then it held basically above the main level from the day before all day. So that tells me that nobody from yesterday is selling, right? Because it's the stock held its high, like held midday for the whole time. Nobody sold out, and then it popped into the close. So obviously, everybody that bought that first day, even though it sold off, they're not panicking out of it.
Wow, this is an $11 billion company. That's what they IPO'd at? Wow.
Yeah, it's a big company, and cybersecurity is just a bigger and bigger issue. Like you see all of these hacks. Like it seems like every week we're getting a new hack, right? Like
Mostly just
there was a
Facebook.
big one over the fourth. No, there was a big one of what was it, like a Swedish grocer or something? That literally they were not able to open their cash registers over the weekend.
Really?
Like there's just a new hack almost every day.
Yeah. Doesn't
Seems to
surprise
make
me.
headlines, man.
Yeah.
Was that just like were they just somebody trying to vandalize their business, or did they try to steal something with that?
I mean,
With
it seems like they're always asking for some money in return, right?
Kind of like a ransom or something. Like,
Yeah.
Interesting. Oh, so Sentinel One's not cash flow positive yet. Is that it? I mean, they're close, I think, but
I,
not yet.
I wouldn't expect it to be cash flow positive. Like we can look at a lot of these new IPOs. Like, we had a bunch of really big ones like Roblox last year and everything else. I actually do want you to look at something, David.
Yeah.
I'm not sure
What's
what the ticker is, but if we want to look at the IPO index, it's the Renaissance IPO index. I'm not sure what the ticker is on that, but
I'm an ape. How do you spell Renaissance? Is it
RENAISSA. Let me find out the ticker on this, but
yeah, David and I don't have very good verbal skills, as was our IQ test results.
okay, guys,
It's
I'm just gonna make it
proven.
IPO USA.
I did like that test though. That trader posted up. It was IPO USA. Is that
Well,
one word?
you guys are, yeah, IPO USA. You guys are damn good traders, so it does not matter.
Yeah,
Very
we don't
much
Oh,
need
so.
here we go.
words.
Oh, okay. Sorry, that was the.
Yeah, so
There
pop
we
it up
go.
on like a daily, maybe. Yeah, so
Yeah.
this is the basically the IPO index of like all of the American IPOs, the one IPO over the last year. They're still holding like some of the ones from last year that went IPO, but still like you can see that these things were like incredible performers. They had like a pretty sharp correction, and like now they're kind of, I'm not sure if they're gonna make a lower high type thing, but just interesting to watch that IPOs have been in vogue lately, last couple of years.
That's pretty cool. So,
Especially since COVID.
what does this chart actually track then? Like, it just like each day it only tracks what the IPOs were on that specific day and how they perform.
Oh no, like what they do is they'll buy the IPOs. Like let's say like for example like Bumble went IPO back in February. Like they would buy shares of Bumble and they would just hold on to them. Now, I'm not sure what the time period is. Like do they drop them up after a year or 2 years or whatever? Like I know they're still holding some of the ones from last year. Maybe
Right.
it's a year. I don't have the exact metric, but they hold all of the new companies, the companies that are just recently listed.
Never seen that before.
So this is just a good barometer just to have on your list, just to watch.
Hmm.
Because I think that IPOs, like, you don't want them to be too hot. Because when they're too hot, they're going to take away money from, the large cap equities and
Right.
like the things that really move the market. But you don't want them to be ice cold too. Because if they're ice cold, then it shows people are just really fearful and people don't want to risk their dollars at all.
Looks to me the ETFs just ran into some supply and is about
Yeah.
to do a 10% pullback. It's interesting. Right into the
I
50.
agree with you. I think it's forming a lower high and then maybe a higher low, maybe an equilibrium.
So that's not good for IPOs. Oh, poor Coinbase.
Yeah, so Coinbase is definitely a big boy on this one.
Yeah.
Right.
What's that at now? Anyways, I haven't looked at that in a while.
Dude, that was a scam and a half, man. That thing came out. And it was like, I don't know if you remember, like there was like the rumored IPO price, and like every day it would go up.
Yeah.
It went as high as 420, I believe. And why 420?
Ooh.
I don't know.
Yeah, I
That's a
drew
little
that in a while ago, but I take that off. I think it's found a bottom.
Yeah, it looks like it has. It's perked up a little bit. So
Silver lining.
yeah.
I just think there's a cap on that, man.
Yeah, well,
I do think it's a good company though. Like I'm not a crypto guy, but I think that like the amount of users that they've amassed and the fact that they can charge like a spread, like if people buy Bitcoin, they charge a pretty hefty fee.
they do.
And if they can turn more into like a crypto bank, so to speak, and they can keep these users for like years and decades to come, I don't see why Coinbase can't be a contender there. I just think it's frothy, and we all know that a lot of the holders, like the employees and executives, they were dumping their stock.
Yeah.
I remember I saw the Q1 report. Maybe it was Q1 report or press release, but they were saying as soon as January hit, almost 40 or 50% of their revenue came from institutions and high net worth individuals. And that's why I'm curious about the Q3 numbers, because I feel like that market's dried up for them. So I'm wondering how it's going to impact their fees for the revenue. And I think that could be a catalyst for taking the price down a little bit further.
Hmm.
Because
Well,
at $50 billion,
is it still 50 bill?
yeah, 50.621.
Yeah, that just does not make a ton of sense to me.
Like how big is Goldman or like a Morgan?
I think Goldman is like, I think Morgan's a couple hundred, maybe like 300-400 if I'm correct, but let's check that out.
But like, new kid on the block comes out 50 billion, gets a decent price, gets a decent percentage value wise compared to like a bank, a full-fledged bank investment firm that's been around for like 100 years. That's
So
unless
Goldman
there's
is 120 and JP Morgan is almost 500, but JP Morgan's like just the behemoth of just the world banking
but you
space.
but even then you look at the two and you're like, is Coinbase really 10% of 10% of that company? Like, you know what I mean?
Yeah.
Just shows valuations are pretty frothy right now.
Yeah,
Um,
especially in the crypto space. And I still think that with Bitcoin and with crypto, I still think there's another shoe to drop. I don't think that that's it. And my whole theory is that when the market does have a correction, because eventually broad market will have a correction, I'm not sure from what point. I think everything's just going to come down together. Like there's going to be a crescendo. And I think that's when Bitcoin will finally bottom. Just like we saw in March of 2020, they all bottomed together. Bitcoin bottoms a little bit earlier, which I think is probably going to happen again the next time that there's a correction. And by the way, I don't think the S&P corrects anytime soon. I think any setback is a buying opportunity, but it's cyclical, right? You make highs and lows. People forget
the
that.
Nasdaq just broke out.
Yeah, we were watching that little ascending triangle for a while on this show. How many times did we mention that it was basing for 6 months?
Yeah.
I will say one thing that's interesting about Bitcoin, though. It seems to be an early warning sign, because usually when Bitcoin tanks significantly, the broader market, something will happen to the broader market within 2 to 4 weeks. I don't know if it's because it's such a high risk asset that as soon as the first signals of something broader is happening, people are pulling their money out of the most risky assets and it kind of like crescendos down. But I have noticed a trend where Bitcoin will react to something and then the broader market will tank shortly after.
Well, that definitely happened in March. Like, when did Bitcoin bottom last time? Like, I want to say like March 5th, I think was the day. And then the S&P bottomed on March 19th. So yeah, like exactly 2 weeks.
Yeah, there you go. So I just thought that was interesting.
Yeah, so I agree. I think that Bitcoin's stuck in the mud right now. No doubt about it. It's going to be interesting, though, to see how low it can go. And I definitely do think that there's going to be a buying opportunity. The first time I've said that on the show, by the way, buying opportunity and Bitcoin in the same sentence.
Yeah.
But, it's the old Warren Buffett saying, man, you got to buy when everyone's fearful and
Yeah.
sell when everyone's greedy. And that was exactly Bitcoin. Like, I still talk about your bet with Willy Woo, man. That one goes down in history.
That one was a funny one because I'm a subscriber to his newsletter. I like his data, obviously. I like his analysis, but when I see something's wrong, I'm like, hold up. Like that's not, I'll put my money down too. So
Yeah, it's funny when you're in this space long enough, when you're investing for long enough, you're gonna have people that you really admire and you love their rhetoric and you love their research and everything else, but you're gonna have things that you just blatantly disagree with, right?
I think, Kaylee, this is probably in your books, but like I figured like it's really important to like form your own opinions. Like it's fine to follow people for whatever, get their feedback, get their appointment, get their perspective, but then you really have to form your own opinion too. Otherwise, how can you either as an investor, Brandon, or like a trader, right?
Yeah, for sure. Because the only way you're going to have confidence to hold on to your position is if you know why you're in the trade, not because someone else told you why to be in the trade, right? Otherwise, you get panicked out and you sell at the wrong time and you buy at the wrong time. You have to make the decision yourself. If you don't, you're never going to make money. Like it's basically
Never take stock tips from anybody. Like you
can
have
take
to have
you can take stock tips, but do your own research and if you come to the same conclusion on your own, that's different,
Well, when
right?
I'm talking about a stock tip is like when you're on the street and someone says, "Oh, buy 100 shares of XYZ company because something big's gonna happen." Like you hear
No,
about these stories all the time. Like people tell me about a company that they really like, and the reason why they like it is because their friend told them to buy it, and
yeah,
I don't know.
yeah,
Well,
that's no way to invest.
when your barber tells you to buy this EV company, you know it's time to sell it.
Yeah,
Right? That's like, oh, pulling the chute. That's it. That's the sign.
yeah.
Yeah, in the book Reminiscences of a Stock Operator, my favorite book, Jesse Livermore, who made billions and lost billions in the Roaring '20s and the Great Depression, he often talks about the shoeshine boy when he's giving tips, or
Yes.
the newspaper boy.
Yeah.
That's always, the best time to sell.
Yeah.
That's my regret, man. I only got like 2 chapters into that book. It's a good book. Sorry, Caitlin.
No, I was just gonna say I gotta read that. That's next on my list.
You have to read it. It's an enjoyable read, and like he didn't actually write it, like someone else wrote it, but it's just an enjoyable read. And he was kind of like a little bit of I want to say like ahead of his time with technical analysis,
Hmm.
because back in the day you would go to these like illegal sort of like underground trading houses, and there'd be kids that like on a chalkboard they would write the price of different shares, right? And they would update them like every hour, right? Because they would come through like Telegraph or whatever.
Hmm.
And that's how you would trade. You wouldn't have a computer. That I don't think everyone had access to a ticker tape. So like he was one of those boys that was like writing the numbers and then erasing them. And every hour he would write down a new number, and he would realize that the numbers, like, they made sense to him. Like there were support and resistance lines. Like he was writing it down, and like it just made sense how things were moving. So then he started putting money down and he started making money because it was really rudimentary technical analysis. Like he was doing like support and resistance, and when you make a new high, you buy, and then when you make a new low, you sell. But it actually worked, and the market was just so inefficient back then.
Inefficient. Yeah.
Hmm.
So those
Yeah.
things work. Like imagine if you, with your trading expertise, were trading back then,
It's
Taking
just so different, man.
and
I couldn't even imagine.
everybody was trading on tips back then. Like no
Yeah.
one really knew what they were doing for sure. And the other interesting thing about that is that people were able to take, I think, like leverage to the point where you were only able to put like 2% down. So you could be like 98% leverage.
Hmm.
Yeah. So like just imagine the margin calls that you would get on that.
Yeah, that's
Things
wild.
were just way more volatile. And there's regulations in place for that now.
Well, plus your spreads on those, like back, I don't know what it was in the 20s, but I know even in like the 70s, it was like, even in the 70s, it was probably still like half a cent, right? Or like $0.50, sorry. It's like the spread would be like, say $26 and 26.50. So like if you buy on the ask, you sell right away on the bid, you're already down 50 cents. And then it just like over the years, it slowly and then it became a 25 cents and then 15 cents, and it just kind of narrowed all the way up to a penny.
Yeah, I think the spreads were pretty big. If I can recall, he was like buying, they were like 25 cents or whatever. And it's just really interesting. The companies that they were trading back then, they're all like either material companies or railroads. Like they were just like one of the two. Like that's why they call it the Dow Jones Industrial Average, because I think there was a rule that like 28 out of the 30 companies on the average had to be railroads. Like it's just really funny compared to now. Like there's what, like how many industrial companies are there on the Dow? You have Caterpillar, Boeing, Dow Chemical. I can't think of any others, right?
Yeah.
So it's pretty funny.
Yeah, I got to read that one.
Yeah, you got to read it. I usually read it every couple of years. I'm gonna read it for like the fourth time, probably in a couple months.
Yeah, yeah. All right, you
Hey,
guys want to wrap?
Yeah. Any closing remarks from any of you guys?
No, I guess theme of the episode to me kind of felt like, just as it always is, it seems to be just do your own research, like you see a news article, somebody tells you a tip, anything, it's fine to for them to point you in a direction, but just do the research yourself, make your own decisions. It's going to give you confidence in your own trades, and then you're not going to make a mistake, and you're going to know why you're in it.
Yeah, I don't think I have anything better to add to that except maybe maybe if you look at analysts, look at their targets, but kind of ask yourself what the questions Brendan were asking, like how did you reach these targets, like what's your reasoning behind it, because those are really important things to know, because clearly they may not know what they're talking about either.
Yeah, the other thing that I want to add is just it was a great Q2. I think that Tom Lee's $4,600 target is definitely not out of sight. I think that we have a lot of pent up demand. We have a lot of money on the sidelines. Interest rates are low. I think being in equities is a really great call right now, and I think 4,600 is definitely in the cards. And I think stay bullish and stay long.
Cool.
I like that.
All right. See you next week.
Great. Everyone have a great day.